You're watching Dukascopy TV. I'm Elaine Stenson and I'm joined in the studio now by Chris Thomas, who's an independent financial analyst. He's here with me now to look at stocks and currencies for the first quarter. Chris, you're very welcome to the studio.
Thanks, Elaine.
So after some very positive US data, we've seen some very weak non-farm US payrolls. How does this affect your outlook for the US economy going forward?
Well, you're absolutely right. Non-farm payrolls came out just over a week ago, and it's entirely reasonable to assume that that was an aberration. It was mainly due to some inclement weather in early December last year in the States, which has caused a very poor number. Now, looking at US data, it has generally been a lot better. We're seeing US retail sales at 4% year on year. That's a lot better than it was, certainly. And Fed Beige Book, that's a lot more positive too. So signs are starting to come along that the US is indeed well out of its recession and it's on its way to recovery. Now, the Fed's Fisher and Plusser have both acknowledged this fact, and they're both pushing for an increase in stimulus reduction, an increase from that 10 billion reduction. Yes. Now, the rest of the Federal Reserve members don't yet want that, so we're likely to see that 10 billion remain for the foreseeable future.
And so what might change that $10 billion withdrawal?
Well, inflation is the key to this. We're seeing the core PCE figure, which is the Fed's favourite measure, Fed's favourite indicator. That's only at 1.1% growth at the moment. The Fed has a target rate of 2%. So until we see an uptick in the core PCE, we're not going to see a change in that $10 billion.
And turning our focus to Europe now, are we seeing the same challenges as we're seeing in the US?
Europe's slightly different. It's further behind still. We are seeing a fragile recovery, definitely a fragile recovery. The GDP is still negative in Eurozone. However, we're seeing some life coming into the retail sales market. So once retail sales pick up even more, that will feed back into corporate profits. And as a whole, the Eurozone will start to slowly improve. Now, Southern Europe, which has been the big problem area, is slowly getting itself back together as well, and the Eurozone will come together as one and become more stable. So yeah, looking more positive.
So looking at currency pairs for a moment, what are your likes and your dislikes right now?
Okay, well, the currency pairs that I'm following most closely at the moment, I'm indifferent to in terms of trading at this particular moment in time. The euro versus the dollar, I would be looking for that going back up towards the 138 level. It was up there just at the tail end of last year and quickly retreated back to where we are at the moment, 135.5. If it goes back up to 138, I'd be a seller at that level. In terms of dollar versus Swiss franc, I like that currency pair too. However, I'd be looking to buy it around the 88.5 level. It's currently around 91, but I'd be looking for a medium-term target of 94 there. Now, looking at euro as a currency, we could say that the scenario that may well happen in the future has already happened in the Australian dollar last year, 2013. Now, Australia, the Reserve Bank of Australia were cutting rates. We had China slowing down and we had commodities slowing down. However, the Australian dollar continued to get strong or stay strong, until suddenly in the middle of April it crashed down, and it crashed aggressively for several months.
Yes, it did.
Now we could well see the same thing happening in Europe, given that the ECB is increasing stimulus and we're seeing disinflation. So watch out for the euro in the coming months ahead.
And finally, Chris, in 2013 we saw some pretty impressive returns on the stock markets. So for those stock lovers out there, where do you reckon they should invest their money?
Okay, well, let's start with Europe. We saw Spain, Italy and France all increasing between 20 and 30% over the last 2 years. Germany, the DAX, outperformed that. They were up 58% over the 2 years. Going forward, however, I think that these still have more upside relative to other developed countries, given Europe has not been a favourite over the last few years. So I'd be looking at European indices relative to American indices to outperform. Now, looking at American positions, companies, I particularly like the financial sector. The reason being that a lot of these have had fairly decent results recently, and given when US 10 years start to move up and the dollar starts to get stronger, we see the profits increasing in these banks, and we'll see the share prices increasing at the same time. JP Morgan remains my favourite. It's had a couple of bad bits of news in the last 3 or 4 months. However, it's still bounced back very well. So JP Morgan would be my preferred stock in the US.
Okay, so JP Morgan are the one to watch. Chris, thank you very much for coming into the studio today.
You're welcome, thank you.
And that's all we have time for now, but do check back for further updates and interviews from the TV team. Bye for now.